Hello, we are back with another educative and engaging contents. Now in this class, let's us look at this topic, net interest income, what it is, how it's calculated, examples. Net interest income, NII, is a key financial metric that represents the difference between the interest income earned by a financial institution, such as a bank, from its interest-earning assets and the interest expense paid on its interest-bearing liabilities. In simpler terms, it is the profit a financial institution makes from the interest it earns on loans, securities, and other interest-bearing assets, minus the interest it pays on deposits and other interest-bearing liabilities. A formula for calculating net interest income is as follows: NI equals interest income interest expense. Now let us break the components down for easy assimilation. Interest income. This includes the interest earned on loans, securities, and other interest-earning assets. It's the revenue generated by the financial institution from lending and investing activities. Interest expense. This refers to the interest paid on deposits, borrowings, and other interest-bearing liabilities. It represents the cost of obtaining funds to finance the bank's operations. Output. Example. Let's consider a simplified example for a hypothetical bank. Interest income, interest earned on loans, $1 million, interest earned on securities, $500,000, total interest income, $1,500,000 interest expense. Interest paid on deposits, $300,000 interest paid on borrowings, $200,000 total interest expense, $500,000. You know we have given you the formula up there, so it is that formula you are going to apply for the above example. Well, the net interest income for the bank is $1 million. This represents the profit generated